Everyone knows the PE ratio, but is it still relevant? And which is better, trailing PE or forward PE? Let's break it down in plain language. Hi, welcome to PSI, Plan, Save and Invest. Today we will decode the trailing PE and forward PE ratios, how investors use them and when these rules work in the real world. What is trailing PE? Trailing PE or TTM PE tells you how much you are paying for each rupee of earnings from the past 12 months. So the formula for price to earnings is current market price divided by earnings per share. 2. What is forward PE? Forward PE looks ahead. It tells you how much you are paying for each rupee of expected earnings for the next 12 months. These estimates, the next 12 months estimates, come from analysts or company guidance. What is company guidance? Every quarter, company announces their guidance. Like they are expected to grow 15% or 20%. Their revenue is expected to grow 15% or 20%. So let's quickly see like how to use this forward PE and trailing PE. Price to earnings ratio. So PE ratio is equal to current market price divided by EPS. So example, let's have a quick example. X stock price is equal to 100. Past 12 months EPS is equal to 10. So trailing PE is equal to 100 divided by 10. So this is equal to 10. So for every 1 rupee you are paying 10 rupees from your pocket. So you might be wondering what I'm paying 10 rupees for every 1 rupee earnings. But you should expect like you invested 100 rupees today and next year the company is going to deliver give you a return of 10 rupees or 12 rupees or 15 rupees. So that's how it is assumed. So that is where PE rupees, the definition might say that I'm paying 10 rupees for every 1 rupee, but the assumption is that you invested today and you're going to hold this investment for next 1 year, 2 years or 3 years, and the company is going to deliver the return with your capital being the same. That is the expectation. So this is called trailing PE. Now what is forward PE? For this we need projected or expected EPS. Let's assume the company is able to grow or they expected to grow by 20%. So we expect EPS to grow by 20%. So let us assume that EPS is equal to 12. Now forward PE is equal to current market price divided by EPS projected. So this implies 100 divided by 12. So that is equal to 8.33. So you can see here the projected, when the EPS is growing by 20%, the forward PE, the projected EPS is 12 and the forward PE is 8.33, which is less than trailing PE 10. So the first thumb rule, what is the first thumb rule? Rule 1. If forward PE is less than trailing PE, that is past 12 months PE, it is considered as positive outlook. positive outlook on that stock. So investors check this. So they are expecting, if the forward PE is less than trailing PE, then investors are expecting the earnings are going to grow, or earnings are going to surge. And it is a positive outlook, and you can, but to which companies this rule applies, that is very important. Forward PE is greater than trailing PE. Should we invest? Only if you have conviction that earnings decline is temporary. And the second point you have to remember, the company has a turnaround plan or cyclical recovery ahead. Or you have done deep fundamental analysis beyond PE ratios. Based on these three parameters, you can invest, else it is wise to avoid. So high PE stocks, should you avoid? Many believe PE above 30 is dangerous, but this is an outdated statement. FMCG leaders like Nestle, Britannia trade at PE above 50 and still deliver great returns because earnings keep growing. So focus on companies with annual and quarterly revenue, operating profit and EPS growth rate of 20% or 50% rather than just looking at simple PE. Low PE stocks, are they bargaining? Not always. A low PE is only attractive if earnings are growing 20% or above every quarter. Cheap stocks without growth can remain cheap. Practical use of PE today. PE is still useful, just in context. Estimating price targets for the next 12 months. Understanding analysts' consensus. Building a long-term large cap portfolio with stable earnings visibility. For these three things, PE ratio is very much important. To value growth companies better, we combine PE with growth rate using PEG ratio. We will cover that in our next video. Please like, share and subscribe to PSI. Share your questions or feedback in the comment sections. We would love to hear you. Thanks for watching the video.